Good afternoon, this is Sean Golden with Golding & Golding, here to discuss the basics of a very common issue that plenty of U.S. persons who worked outside of the United States have to deal with, which is how do you report foreign retirement to the Internal Revenue Service each year. There's various international reporting forms. We're gonna dive into it a little bit. So from a baseline perspective, foreign retirement. Foreign retirement could be employment-born or non-employment-born. For example, you could be receiving your retirement, a deferred growth like a 401k. Otherwise, it could be something that you invest in order to buffer or supplement your retirement. In terms of treaty versus non-treaty, that deals more with the tax aspect of it, unless you're making an election to be treated as a foreign person under a treaty, and that may impact the reporting. But typically, treaty versus non-treaty will impact whether it's tax based on source or whether it's based on residence. There's many different types of foreign retirement plans. Some of the common ones are CPF in Singapore, MPF in Hong Kong. You have your Superannuation in Australia, and you've got your SIPP in the UK. So what are some of the common reporting requirements for foreign retirement? You'll find as you journey through international tax and international reporting that there's lots of different forms and acronyms. But the two main reporting requirements for accounts, well, three, but the two main ones are the FBAR, Foreign Bank and Financial Account Reporting, otherwise known as FinCEN Form 114. It has usually the lowest threshold for reporting. Most people think of FBAR and they think, oh, that's a bank account. And that's sort of how it was initially created, but in terms of how they enforce it, it's any foreign financial account, which could mean anything, and it typically includes foreign pension plans. A quick interjection: if you have a U.S. pension plan, let's say an IRA, and then you have foreign accounts in a regular qualified plan, then you generally don't have to report those accounts in the U.S. plan as on the FBAR. This is different. This is just if you have a foreign retirement plan, then generally that's going to be included on the FBAR. And the same goes with FATCA. Excuse me. FATCA is the Foreign Account Tax Compliance Act. It was introduced on the 2011 tax return, I think it was. And generally, it requires U.S. taxpayers to file a Form 8938 to report their foreign pensions. Foreign pensions definitely are reportable on the Form 8938. There's a separate section for things like foreign pension and other assets. Schedule B is used for dividends and interest, but there's also questions on the bottom of the form that will ask whether you have ownership or signature authority over a foreign financial account, and whether you have to file a Form 3520 foreign trust sort of situation, which gets much more complicated. But if you own a foreign retirement plan, then you would typically mark yes for Schedule B, even if the threshold of the account is below FBAR FATCA. That's not what Schedule B is asking. It's just asking whether or not you have ownership or signature authority. It can get much more complicated from there depending on the type of foreign retirement account someone has or plan and what kind of assets underlie it. The Form 8621 is used to report passive foreign investment companies, but that includes things like mutual funds and CCOVs and foreign mutual funds, CCOVs and things like that. So it can get much more complicated depending on what type of foreign retirement you have and what kind of assets underlie it. Is there a treaty with that country? Because that may impact whether the growth within it is taxable. And then if you're grossing it up in your income, then that may impact whether you have to report the individual funds underlying it separately or not. As you can see, that's beyond the scope of this, just something to consider. And then there's Forms 3520 and 3520A. 3520A is reporting, or either one of them are reporting ownership of foreign trust. 3520 also if there's any trust distributions. It's a much more complicated form than the FBAR Form 8938. Requires more of like a balance sheet breakdown of the income generated by the trust. Taking a step back, foreign retirement plan typically will have an owner, settlor. It'll have a trustee and it'll have a beneficiary, and that's how it kind of falls into the reporting requirement of being a foreign trust. It's not like one of those offshore trusts you just hear about in the Bahamas or something, right? It's more like a technicality, and it's generally not going to be considered qualified. There are some exceptions. For example, Rev Proc 2014-55 specifically exempts things like RRSPs and RRIFs from Canada of having to be reported on the 3520 or 3520A, although it's still included on the FBAR and FATCA. More of a catch-all is new Revenue Procedure 2020-17, which provides, the goal is to avoid duplicative reporting. Back in the day, the Canadian RRSP and RIFs were some of the more common types of reporting, and with the globalization of the economy, there's many more types, not that the IRS can come up with a specific rule for each one. And so 2020-17 just basically goes with the idea that to minimize duplicative reporting, if a person has a type of foreign employment deferred tax pension or non-retirement deferred tax pension, and it's tax deferred in that country, and it meets various requirements under the revenue procedure, which are a bit ambiguous as most revenue procedures are, then it can avoid reporting on the forms 3520 and 3520A. Again, sort of like the other Rev Proc 2014-55, it still does require reporting for things like FBAR and FATCA. If you're out of compliance and you haven't properly reported your foreign retirement, there's plenty of amnesty programs to assist you. There's VDP if you're willful or just can't certify under penalty of perjury that you're non-willful. There's a Streamlined Domestic and Streamlined Foreign Offshore disclosure programs. Both of those are for offshore accounts that would include foreign retirement plans. The domestic and the foreign refer specifically to the residents of the taxpayer. Are they U.S. or are they foreign? There's also alternatives to Streamline, which is reasonable cause delinquency procedures. We have a ton of free information available on our main websites and our sub websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate and it's something that we handle. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.